Hello. Welcome to our video on fractional reserve banking. This is a topic that can seem complex, but don't worry, we're going to break it down in simple terms and explain how it impacts our economy. Before we start, let's get a basic understanding of what fractional reserve banking is. Imagine you have a bank and a group of people deposit their money into that bank. The bank is then required to keep a certain percentage of that money, called a reserve ratio, on hand to cover any withdrawals made by the depositors. The reserve ratio is set by a central bank, like the Federal Reserve in the United States, and it typically ranges between 10% and 20%. So, if the reserve ratio is 10%, the bank must keep 10% of the deposited money in reserve, while the remaining 90% is available to be loaned out to borrowers. This is the basic concept of fractional reserve banking. Now you might be wondering, how does this impact the money supply in our economy? Well, remember that 90% of the deposited money is loaned out. That money is then spent by borrowers and enters into circulation, creating new money in the economy. This process is known as the money multiplier effect. With a deposit of $100 and a reserve ratio of 10%, the bank can create up to $1,000 in new money. This is how fractional reserve banking leads to an increase in the money supply in our economy. It's important to note that fractional reserve banking can also have an impact on inflation. When the money supply increases, the prices of goods and services can also rise. So, when banks create new money, they can contribute to rising prices, which we call inflation. However, it's not all sunshine and rainbows when it comes to fractional reserve banking. There are limits to how much new money can be created, as the bank's cash reserve limit and the limits of banking technology prevent the velocity of money from increasing indefinitely. In conclusion, fractional reserve banking is the practice of banks holding a certain percentage of deposits in reserve while the rest is loaned out to borrowers. This leads to an increase in the money supply, but also has the potential to contribute to inflation. While it has its advantages and limitations, understanding fractional reserve banking is key to understanding how our economy functions. Thanks for watching.